Welcome back, everyone. We're about to begin our first panel session of the day. So please don't forget you can ask questions throughout the session via the Q&A tab. This conversation is especially timely with the recent election of Kamala Harris as the first Black woman vice president of the US. Change is happening, though the pace is slower than anyone would like. We still have a lot of work to do, some of which will require us to move away from the low impact, quick fix practices and towards aligning incentives and implementing processes and practices that have proven to drive measurable change. And now to begin the session, please welcome the PRI's Head of Social Issues, Elena Espinoza.
Thank you so much, Lindsay, and good morning, everyone. And thank you for joining the session titled Diversity, Equity, and Inclusion, the Myth of Meritocracy. So we hear over and over that diversity is good for business, but if it's so good, then why don't we see more of it? This is most likely because one of the key obstacles to diversity is probably existing social biases. So many diversity efforts tend to focus on the metric or number without considering the importance of creating an inclusive work culture that empowers individuals and allows them to truly participate in the decision-making of the workplace. And many well-intended initiatives assume that the base is fair and do not recognize the advantages and barriers that exist, and that as a result, not everyone starts from the same place. An example of this is a recent FT article, that's the Financial Times article, which cites Lael Brainard, a Federal Reserve governor, who has warned that the economics classrooms are looking less and less diverse, and is encouraging the field to think seriously about diversity in universities, so this can also expand to government, think tanks, and businesses. However, the same article goes to point out that increasing the numbers is not enough, as evidenced in a 2019 study by the American Economic Association that shows that students of color report having experienced discrimination at school and at their jobs with a lot more frequency than other respondents. A recent publication from the management consulting firm McKinsey titled Women in the Workplace 2020 shows that in corporate America, even though women represent 47% of the workforce at entry level, of this, women of color represent 18%. And when we look at C-suite, this number in terms of women drops to 21%, and if we look at women of color, it drops to 3%. Another example is a field experiment performed by two professors from the University of Chicago, where they sent fictitious resumes to respond to job adverts in both cities of Boston and Chicago. This showed that the CVs with white-sounding names received 50% more callbacks for interviews than those CVs with African-American sounding names. The study goes further to say, and I quote, "The amount of discrimination is uniform across occupations and industries. Federal contractors and employers who list equal opportunity employer in their ad discriminate as much as other employers. We find little evidence that our results are driven by employers inferring something other than race, such as social class, from their names." So in today's session, we will aim to address this assumption that the base is fair, and our speakers will talk about how investors can think differently about diversity, equity, and inclusion and address these issues in their own organizations as well as in their portfolios. So today joining me, I have Camilla Sutton, President and CEO of Women in Capital Markets, which is a Canadian and national not-for-profit that aims to accelerate gender diversity across financial services. Craig Slack, who's the Chief Investment Officer for the Office of the Chicago City Treasurer, Melissa Conyers-Irving, where he oversees a team of professionals who manage and monitor the city's investment activity, develop short and long-term investment policies, and maintain investor relations. And Essma Bengabsia, Senior Associate in Sustainable and Impact Investment at Glenmede Trust, where she's responsible for researching and identifying investment opportunities in global public markets. So to kick off the discussion, the speakers will offer introductory remarks for around 5 minutes. Then we will have a moderated question and answer session, and then you will have opportunity to ask questions as well of our panelists. So without further ado, Camilla, thank you for joining us today. If we start with you, so we know, the investment industry as a sector, we consider that it could be one of the worst offenders when it comes to diversity. So what are the leaders in this space focusing on, and how are they measuring and assigning accountability for this issue?
Well, thank you very much. It's a pleasure to join today. I'll take a little bit of issue with the industry's the worst. I do think we have lots of areas within the industry that are doing very forward-looking pieces, and lots of other areas that are still entering the journey, shall we say. I think what's going on in terms of what the most forward-looking companies are doing is really quite clear, and it's quite different than what's been going on for years. So I think traditionally for the diversity space, when it comes to the financial industry, it's been focused a lot on things like training women in leadership programs, or training the BIPOC community in leadership programs. It's been very focused on celebrating some wins and bringing awareness. I think what we're seeing now is that the dialogue has shifted tremendously. And so I think the firms that are truly at the leading edge are kind of doing 6 core pieces. So the first one is that they're really owning it, and they're holding themselves as a firm accountable. And they're also recognizing that even within their firm, there are structural barriers and structural inequities that are limiting the progress of certain groups of people. So that's the first one. The second one is they're increasing equity literacy right across their firm. And that doesn't really mean unconscious bias training, things like that. That's really much more focused on equity literacy. So from the basics, what is race? What's the difference between equity and equality? What is going on in the space? Much more so than trying to recognize your own bias. The third big one is they're really focused on measurement and reporting and transparency. And that doesn't mean just the little happy, rosy stories we have here and there. It really means focusing in on, do we have the right data across gender? Do we have the right data across race? Do we have the right data for sexual orientation? And then let's be very transparent with that data and where we want to go and what the roadmap looks like. I think the fourth one is that they're implementing targets. There's a long road ahead of us before we can really remove all the structural barriers that are in place. And as a gap or as an interim measure, a lot of firms have decided it's time to implement targets as we continue to work internally. The fifth, and this one might even be the most important, is that they're really reducing the focus on the individual. So they're no longer trying to fix the individual people or give individual groups leadership training or mentorship. And they're really focused on the system itself. So they're looking at what within our organization is creating a structural barrier, systemic problem that we can actually start to bring down. And that's everything from what schools you recruit from, to the way the promotion process works, to how feedback happens. Those are the critically important pieces. And the last one I'll comment on, because I think it's an important one, is that they are ensuring that within their firms, they are free from harassment and discrimination, and they have a zero tolerance policy in place. And I think those, Elena, to answer your question about what are the really forward-looking firms doing, I think that's exactly what they're doing. They're owning it. They have targets. They're measuring. They are fixing the system, not the people, and they're ensuring their work areas are free from harassment and discrimination.
Thank you very much, Camila. And I think speaking of owning it and doing a lot more in terms of diversity and the work within the investment firm, Craig, if I go to you now, I know in an effort to improve diversity within the investment industry, the Chicago City Treasurer has created a diversity scorecard as a way to work with more diverse broker-dealers. So could you talk a little bit more about what motivated this decision and to make this commitment, and how it aligns with your fiduciary duties?
Yeah, certainly. And Elena, thank you. It's a pleasure to be with you and the panel today. It's really inspiring to hear about the great work that everyone is doing here. And I appreciate the question and really shedding some light on what I think is an important initiative for my office. I knew one of the first things that I wanted to do when I started in my role about 1.5 years ago was change the RFI, the broker-dealer RFI. By ordinance, we're required to do our trading through a list of approved broker-dealers that are selected through an RFI questionnaire. And quite honestly, the process was completely antiquated, both in its delivery and in its content. We were basically getting these big, thick, hard copy books of information we weren't using. And when I asked my team why we were doing it this way, the only answer I was getting was, this is the way we've always done it. And from my way of thinking, when that's your best answer, it's probably time to blow up the process, because you can probably look to do things a little bit better. And when I met with the treasurer to kind of give her my thoughts on some of the changes I wanted to make, my my thinking was, producing a much more streamlined RFI that would be delivered on an electronic platform, with more current and relevant questions. But nowhere in my thought process was a deep dive on DE&I and CSR. And that's the angle she was coming from. While at the end of the conversation, I think she completely understood my perspective on execution metrics, firm capabilities, and compliance. She wanted to know how we were actually selecting the brokers we were trading with, how they were getting paid, what their firms look like from a diversity perspective, and what they were doing to give back to the communities they serve. And specifically, what were they doing here in Chicago? And I had great answers for almost everything except the D&I questions and the CSR questions, and those were the things that were most important to her. So she asked me to bring all the broker dealers together, and so she could explain to them what she expected and what it was going to take to do business with the city of Chicago. So, out of that meeting came the save the date for the city's inaugural broker dealer diversity and corporate social responsibility symposium. And I had a mandate to create a scorecard to select broker dealers. And just a few weeks later, we had an incredibly powerful broker dealer symposium where the treasurer was able to share her vision for change within the financial services industry. We had executive leadership from a number of investment banking firms from across the country sharing really next generation ideas on D&I and CSR. And I was able to introduce the upcoming changes to the RFI and the subsequent selection process. And we had about 350 people in attendance, and the feedback was off the charts positive. It was really, the first time a lot of these people were hearing this message, and that change was on its way. It wasn't threatening or angry. It was very open and collaborative, and I think it was really desperately needed. It was really the takeaways from that symposium that became the heart and soul of the scorecard. Of course, traditional execution metrics and market capabilities are always going to be a major part of any broker-dealer selection process. But up until that point, the only questions we were asking about diversity was about ownership structure. Did they qualify as an MBE, WBE, or DVBE firm? Now, ownership metrics are great, right? But we really wanted to reach through ownership to make sure that all of the broker-dealer counterparties were aligned with the residents of the city of Chicago. We wanted to ask much tougher questions about a firm's employment demographics, not just how many racial and ethnic minorities and women you employ, but how many of those people are in professional or executive roles. We asked to see their D&I policy. We asked about their quantitative goals for recruiting, promotion, and compensation related to minorities and women. We wanted to know if they had mandated training related to diversity issues. Do they have active ERGs? We also wanted to see their CSR reports and their philanthropy budgets. So we really think we've created a solid framework for selecting broker dealers. It helps to align us with real thought leaders in diversity programming. But Elena, I think you ask a tremendous question and raise an interesting point about aligning with our fiduciary duties. As Deputy Treasurer and Chief Investment Officer of the City of Chicago, I really view my role first and foremost as the primary fiduciary of taxpayer dollars. I have several mandates, but chief among them is to achieve the highest risk-adjusted returns possible using allowable investments. In fact, I need to validate that with our auditors on an annual basis. But I think it's important to note that as a municipality, we also have civic responsibilities that other institutional investors don't necessarily have. We feel very strongly that when possible, we need to use taxpayer dollars not just to produce income, but we also need to help drive impact. I think this scorecard is not just the right thing to do, but I would also argue that it helps to align those civic responsibilities with our fiduciary duty by producing a list of the most capable, dynamic, and forward-thinking investment firms on the street. At the end of the day, we have a very unique platform that allows us to drive impact and at the same time create a social return on investment.
Thank you so much, Greg. And I think, speaking of this making sense as well in terms of your fiduciary duties, I will go now to Essma. And yes, our third point of our discussion is how better diversity in the investment industry can drive better diversity and inclusion in portfolio companies. So, however, the lack of access to financial capital continues to be an obstacle, limiting the growth of minority-owned business. So what role is Glenmede Trust playing here to address this issue?
Sure. And thank you so much, Elena, for organizing this session and for having us here today discussing this extremely timely and important subject. To your point, I just want to share a few stats on the barriers that both women and people of color face when attempting to access capital for their businesses and their enterprises. In terms of venture capital, for example, only 1% of VC-backed founders in the US are Black, and less than 2% are Latino. And roughly 3% of VC funding in 2019 went to female founders. And when we look at business loans more broadly, studies show that in the US, when a business is owned by a person of color, a non-white person, banks and financial institutions are 3 times more likely to deny them access to a loan than their white counterparts, white business owners, again, holding constant for various factors such as creditworthiness. And when those business owners of color do get that capital, on average, they get smaller principal amounts and are charged higher interest rates. So that's just one example of how we're seeing barriers that diverse individuals face when attempting to access that capital to build their wealth, to build their businesses and their enterprises, and really achieve that socioeconomic mobility. So what we're asking ourselves at Glenmede is, how can we identify opportunities to advance racial and gender equity across every step of the investment process? So we took a step back and said, all right, let's kind of just follow the flow of capital from, the minute it's in the hand of the client to when the client hires the investment manager. And now that investment manager has those assets, the investment manager is now identifying investment strategies, portfolio companies to invest in. And then once they invest in the companies or the strategies they select, then those companies are now using that capital to run their business operations, produce their end products. And so along the process, they have a supply chain, and they might be, if they're manufacturing a product, for example, they are producing externalities that will affect any stakeholders across the supply chain. And so that's how we're kind of seeing the flow of capital go. So what are the opportunities to advance racial and gender equity across every step of that process? And so step one we think about is what is the diversity of the investment managers? Craig touched on this quite deeply in terms of the scorecard that he and his team run to determine what is the racial and gender diversity of those investment managers. In the US, only 1.3% of assets under management are managed by firms owned by women and people of color combined. So we're talking about, over 98% of assets under management are managed by non-diverse individuals. By comparison, in the US, almost half the working age population is now people of color. And so when we look at just the numbers, we're a numbers industry, right? So the numbers don't add up. Clearly, there are barriers that are preventing diverse individuals from having that access to that capital to manage. So now how can we as investors and capital allocators identify diverse investment managers to invest with across asset classes? And then step two, in terms of the companies we're looking at to invest in, how can we identify investment strategies and companies, if we're directly investing, that have that diverse representation? So again, taking what Craig discussed within the scorecard and implementing that across not only the investment managers we allocate with, but also the companies who are allocating our capital to. And then the last step is looking at the core function and the externalities of the companies. What are those companies producing? What services, what end product are they producing? And how are they affecting or engaging with the stakeholders that they might impact? And is that positive or negative? So I can give a few examples. When we think about, for example, food security and the food desert problem in the US, food deserts disproportionately affect low-income communities and communities of color in the US. So an example of a positive investment would be to invest in, for example, supermarket chains that are actively seeking to tackle the food desert problem and provide low-income communities of color with access to healthy foods and fresh produce. On the flip side, when we think about investments that we would rather avoid and not take on that risk in our portfolio, we can think about, for example, private prisons and immigration detention centers. In 2018, we saw major headlines covering how many privately funded immigration detention centers were caging migrant children who were being detained across the US-Mexican border. So as investors, we can ask ourselves, from a moral standpoint, do we want to allocate to institutions that are caging children? And from a risk management standpoint, what's the headline risk within that? What is the volatility that might be taken on in a portfolio by allocating to those investments? So really looking at the core production and function of that company, and based on how it fares, either saying, yes, we want to invest in this company, we see a value add, an opportunity in it, or B, we see significant risk and significant social and governance related egregious behaviors in this, and we won't allocate to that investment. So that's really the broader framework of how, again, we're seeking to look at the effect of our capital across every step, and then seek to create positive externalities and positive output across every step of our capital flow.
Thank you very much. So now we're going to do a little bit of a question and answer with the whole panel, and hopefully this will flow into a discussion and a conversation. So I just wanted to start with you, Camila, and just thinking, I mean, the point that you were making as well, in terms of like, it's necessary to have metrics and to have targets, but obviously sometimes if we focus too much on those, what we get is the feel-good story and the rosy result, and not necessarily addressing the issue of diversity and inclusion. So do you mind giving us a little bit more of or more comprehensive example of what like interventions investors could use to drive better diversity and inclusion in hiring and promotion practices?
Absolutely. So I think a few things are really critically important in what you just said. Measuring is obviously very important, but you have to be measuring the right pieces. So there's no point in measuring your complete workforce in terms of gender, because you'll often come up with close to 50-50, even though most of the women are in the very more junior and lower paid areas, potentially even call centers, depending on what kind of business you run. So really what's important is measuring the core investment group across different levels of seniority, so you really have an idea of where you have different representation. And it's important that you don't do it just for gender. It's critically important that you're doing it for race and sexual orientation as well, so you can really get a feeling for where do you have areas where the numbers are changing rapidly, and where they aren't changing, that gives you the clues in terms of what you need to be doing. As a basic starting point in terms of hiring, you mentioned, Elena, I think that, it's really important that we're not fixing the people, we're fixing the system. And this is a great example of that in terms of hiring. So for instance, often when we hire, it's I know somebody and I get along with them well, we share a lot of things in common, and maybe even our kids go to the same school. Well, all of a sudden we've just introduced about 10 different biases, and now there's real reasons why this person is very comfortable to me and I think they might fit the job. But if instead I had a list of criteria in front of me and I asked every candidate that sat in front of me the same standardized questions that could really measure those criteria, and at the end of the day, I circled back and measured my candidates and their answers to those set questions against the criteria. All of those things that we might have shared in common, like our kids go to the same school, or we golf at the same golf club, or any of those commonalities, even that we together went to the same university or college, all of those things disappear, and we're really now focused on the role, the criteria, and the success factors. And that actually tremendously improves our hiring, but it also adds in a lot more diversity into our pools and our talent pool. So I think that that's a really simplified example, but if you start to do that across all of your policies internally, you'll start to really bring down some of the structural barriers, and you'll really be actually improving your talent pool immensely, and at the same time adding tremendous amounts of diversity.
Thank you. And continuing on that line, Craig, I guess the question is then what are the results that you expect to see from including more specific questions around diversity and inclusion on your RFI questionnaire?
Yeah, as I mentioned earlier, execution metrics and market capabilities are always going to be, a major part of any broker-dealer selection process. But with our scorecard, 30% of the overall score is now directly tied to a firm's leadership efforts in DE&I and CSR. What we've really tried to do is make the process as objective as possible. But in general, firms that are laggards in the areas of DE&I and CSR are taken out of consideration to become approved broker-dealers. This past year, we went from 58 approved brokers to just 33. 42% of the firms we approved qualified as MBE, WBE, and DVBE status. But more importantly, we believe that really all of the firms that we've approved to do business with have established themselves as industry leaders in diversity programming. And we now have what I think is established a watermark for by which we can measure improvement or deterioration. Look, Chicago is the third largest city in the country with 2.7 million residents. 30% of our population is Black, and 30% is Hispanic. And I think, as Essma mentioned, that's kind of an important driver of what we do. We manage about $9 billion, and that money really belongs to the taxpayers of the city. So we also think, we think when we have a constituency like ours, we think it's also important to establish ourselves as a thought leader in areas of diversity, equity, and inclusion. And I really think driving a stake in the ground and saying these are the things that are important to us, and this is what we expect from the brokers we do business with, is the right place to start. But listen, anyone can create a scorecard that uses DE&I and CSR to assist in the selection process. That's the easy part. The real work in the scorecard, is the engagement that follows. It was important to us, important to me, to spend time with every one of the firms that we removed from our list to explain how the process worked, why they were removed, and I wanted their senior leadership involved in the discussion. My goal wasn't to be confrontational or point fingers. I wanted to have an open, honest, and frank dialogue, about the issues that could hopefully lead to some positive changes within their organizations. And I wanted them to apply again. And then on the other side, we wanted to share the information we were gathering so that the firms that were doing an incredible job could see where they might be lagging their peers. I had a really great conversation with Dave Casper, who's CEO of BMO Harris Bank here in Chicago. And Dave was a keynote speaker at one of our town halls, where I was going to discuss the results of our inaugural scorecard. And he was genuinely excited to hear about what we were doing. And he said to his team that was there with him, I want you guys to spend some time with him to discuss this. I don't know how we did, but whatever it is, we can do better. And I think it was really that encouragement from a local leader that made me think we were on the right track. As I don't think you can have effective organizational commitment to things like DE&I and CSR without complete and unwavering buy-in from the top of the house. Well, I think there's a number of ways, different ways to measure success in the data, like Camilla had pointed out in her conversation. I really think it's the change in organizational culture that will generate the real systemic solutions that are being called for. And that's really what we're pushing for in our engagement.
Thank you so much. And Essma, I think, going to your point as well, again, just keep talking about the numbers. And obviously, this is a numbers sector. So can you tell us a little bit more about what results have you seen in economic terms and in increase in diversity and inclusion terms as well from investment strategies that focus on race equity?
Absolutely. And before I dive into the economic impact of racial disparities in the U.S., let's kind of level set with the demographics. The U.S. Census Bureau projects that by 2042, the United States will be a majority minority population, meaning non-white racial groups in total will constitute over 50% of the population. So when we think about racial disparities, the racial disparities that exist in the US are going to affect over half of the population in the United States. That has serious economic impacts for the GDP growth and the prosperity of the US economy when over half of the population is not able to sufficiently access capital, loans, quality education, livable wages, equitable opportunities in the job market, and so on and so forth. Citi recently released a report where they project that racial disparities in the U.S. have cost us about $16 trillion to date. In addition, studies show that the racial wealth gap is currently increasing and widening and not decreasing. And that's extremely important because projections show that at the current pace, by 2053, the Black median wealth in the United States will be $0. And by 2073, the Latino median wealth in the US will be $0. And so let's think about the macro implications of that and what that means for the US overall. Again, when a significant portion of the population is set to reach $0 in median wealth within the coming decades. And now when we think about kind of what can we do about that as investors in terms of our investment products and our capital allocation, a lot of the practices that my co-panelists had shared are extremely crucial. And when it comes to our investment management, what's important is to think about racial and gender equity as an approach and not one product or one ETF. There isn't going to be this kind of magical ETF or venture capital fund that we bring to market that's going to fix all of these structural issues in terms of our capital allocation practices. This is really an approach we need to incorporate across any strategy, impact or not, ESG or not. So asking ourselves questions like, what is the diversity of the investment manager we're allocating with? That can be an investment manager of an impact strategy, or it can be an investment manager of your traditional hedge fund strategy or your small cap equity strategy or whatever the asset class is. Studies show again and again that there's a strong correlation between stronger financial performance and more diverse teams, both from the gender and ethnic standpoint. In addition, when it comes to the nature of the investments we're making in terms of the companies that we're investing with, I use the example of investments in private prisons and immigration detention centers previously. From the moral and kind of the ESG standpoint, obviously an investor would not want to allocate to private prison and immigration detention centers for clear social and human rights related reasons. In terms of the financial risk that's taken on in the portfolio, with the increased headline risk around those investments in 2018, we also saw an increase in public protests and outrage around financial institutions that were lending and investing in these types of companies. And as a result, we saw about a dozen banks within 2018 and 2019 publicly commit that they will no longer provide financing to these companies. Now, many of them made the commitment on the lending side and not yet on the equity financing side. But all this is to say, the companies that announced they will no longer lend to these institutions constituted about 87% or so of the credit lines of the two largest private prisons in the US. And so incorporating this approach across every type of investment strategy, across every type of asset class is extremely crucial, again, regardless of whether you label that strategy as ESG or not, because of the implications, both on a micro and macro level, that this can have for your portfolio.
Yes, thank you very much. I think, yeah, we've heard, there is a lot already going on in this space. We see that there is quite a positive results, but however, there is a lot of work to do on this issue and a way to go. I think, Craig, if I could come back to you and then just go a little bit, I think it's been very positive, the response that you've received from including these questions on your RFI. However, I just wanted to check a little bit more with you then, what will be the consequences for firms that do not meet the required criteria? And you touch a little bit on this. But yeah, if you can just tell us a little bit more about that. And also what differences in terms of the broker dealers that now are using the questionnaire, have you seen different broker dealers applying, or what changes in practices have you seen using this new questionnaire? I think you're on mute, Craig. Sorry.
I'm sorry. It wouldn't be a presentation without a mute violation. But I think the real result for us was taking the number from 58 to 33. And what I found was that when you have too many broker dealers that are counterparties, you sort of lose your deliberate and intentional work that you're trying to do to get to the diversity, equity, and inclusion results that you want. So by bringing the numbers down and including more of the people that were what I would say were diversity programming leaders, I think it's helped really drive our intentionality with our trading activity. But I think more importantly, it's the dialogue that we've had as a result of the process, right? It's the engagement. What we're trying to do, traditionally our point of reference is our sales coverage and maybe some of our trading coverage. I don't know, Essma, if that's the same for you. But what we're trying to do is really get through our traditional coverage metrics to get to the leaders of the ERG groups, to get to the diversity leaders within the organization, and then get to senior leadership to have an active dialogue about what we're trying to accomplish. The risk you run, though, Elena, is when you try to push too hard, you might get some of the unintended consequences that you're not looking for, right? Because we do still have that fiduciary duty that you mentioned earlier to get the best execution metrics. So we have an expression, is the juice worth the squeeze? And so if we're not important or relevant to our counterparties, are they going to go through the process? Are they just going to say, listen, I just need to make this go away? It's not that important of an account. So really, from my perspective, I've got $9 billion, right? Essma, you've got a lot more than that. You're an allocator, sufficient size assets. $9 billion sounds like a lot of money, but really in the grand scheme of things, it's not. So, I realize I've got a small lever. What I really need is partnerships, right? I need more people like me to start implementing the scorecard so that we can help drive that metric and that conversation across a broader platform. And so that's what we're really going to be looking to push with this particular RFI. If I'm being perfectly honest with you, I don't think we got enough engagement and publicity around the first iteration of this. So we were hoping 2.0, we get that. We're hoping that our friends at PRI are going to help us with that and help push the narrative. So what we really need is partnerships.
Thank you so much. So yeah, we've been having a couple of questions coming in. So I'm just gonna grab a couple of questions from the audience and then just maybe ask one of you to address it. I think there are one of the popular questions, one says, how can you measure success related to non-visible characteristics? And should we oblige employees to disclose this? Maybe Camila, would you like to take on that one?
I'm happy to. I think that I know that you have some global participation, so it is a little bit different in every country in terms of what you're allowed to ask from your employees. In Canada, we have a lot of kind of count yourself in surveys, which is really a way to try to understand within a firm where we have different representation from different groups across things like sexual orientation and race. And so there's a lot of pre-communications done in order that employees really want to count themselves in and that they understand the positive messaging and the positive impact that can have. So definitely the measurement has been a key focus in terms of how can we do a lot better with the data. But this is a data problem, and we have major solutions to data problem. And so I think that what's really important is that there's a communication plan that is matched with the collection of data, and so that employees really understand what that data is going to be used for and why it's important to them, and how it aligns with their anti-racism commitments, how it aligns with their gender equity commitments, all of those pieces. Because if you don't do the communication piece, the fear is then that you don't actually get the data accurately. And that is not what you want. And but I will reiterate, in every country, it's slightly different. In some countries, you are allowed to ask that even on the application form. So it really does depend a little bit on wherever you're located, geography.
Thank you. And we're getting quite a few questions. So I'm trying to group them together and see if this works. And I think, Essma and Greg, Greg, would be more for you. So it's how should one weight allocation to more diverse companies versus those that show legitimate improvement in diversity? And there is a related question that is, do you suggest divesting right away when dialogue is not open or you feel engagement is the way to go? Craig, would you like to go first?
I'll defer to Essma. That's an allocation. That's an allocator's question.
Sure. I know these are two excellent questions. I'll take the first one first in terms of diversity. This was actually a question that the panelists had also discussed in our preparation, because what we often see is that if you look at diversity at a broader as a broader number across an entire workforce, you might have a company that, let's say, is 40% women of color. But then when you dig deeper and try to see, all right, where are the women of color represented versus everyone else? It might be, for example, a hotel company where all the housekeepers are the women of color, but all the executives might be an all-white, all-male team. And so looking at diversity at a deeper level within a company and not just taking that general metric is extremely crucial. Now, of course, and this will also answer the second question, there is a lot of value in investing and engaging versus divesting. And I think this is kind of the million-dollar question across every impact area, not just as pertaining to diversity and inclusion. And I think for an investor, it's crucial to assess, what is the opportunity for improvement here? Has the company shown willingness to improve around specific practices, or is there really just no shot? And I think going back to Craig's point on partnerships, that's extremely important because with partnerships, with a lot of shareholder engagement, coalitions, the opportunity for impact is real. I'll give two quick examples. In New York City, for instance, Scott Stringer, the New York City comptroller, wrote a letter to over 60 companies asking them to publicly disclose their government workforce diversity data, and approximately half responded and committed to disclose that data across ranks within the company, across gender and racial diversity. And that's pretty significant because if you look at the companies who answered his call, they include Goldman Sachs, they include BlackRock, some really important players within this industry as well. Similarly, the state of Illinois and the state of Connecticut are leading a coalition of investors, and they're reaching out to all the companies in the Russell 3000 to get them to similarly also disclose this data. And so this engagement is crucial because this is step one. And then step two is then working with them to improve that data, to create the pipeline for women and people of color to be able to climb up those up the ladder in those companies. And so the potential in that is ginormous. And I definitely encourage viewers to look into those, explore opportunities to participate in those coalitions and partner with Craig.
Yeah, Essma, that's a great point. We're a part of that MIDI group that's working on engagement and soliciting the Russell 3000. It's an incredibly powerful group and getting some really good results on gender diversity and ethnic and racial diversity on board seats. So really good initiative.
Yes, and I think we're running out of time, unfortunately. I wish we had hours to keep discussing this, but I guess I have one last question, and maybe Craig, I will give this one to you. And you have only 30 seconds to respond. Sorry about that, but like in a very short answer, for people that are looking at this for the first time or starting, specifically like working in the investment industry, where do you advise them to start?
I would advise them to start by calling me. Or sending me an email by outreach, and I'll talk to anybody that wants to talk about this and how to get started. Because I will tell you, it was when I was tasked with this, I thought, how am I ever going to do this? And you start looking at it, you sort of get lost in the sprawling data points that you get. But when you get to the end of it, you feel like you've done something really positive. So I think, why reinvent the wheel? Let's talk together and maybe see how I can make my product better. And you can take it. I find ESG and D&I and CSR, when people are involved in that space, they're very open to helping. All you have to do is raise your hand and say, I want in. And I think you'll find that people will say, whatever you need, from the state treasurer, your peers, whatever you need, and start by calling me.
Thank you so much. Well, yes, we have reached the end of the session. I think we went a little bit over even. So thank you so much, Essma, Camila, and Craig, for joining me today. And I hope the audience has learned a lot on this issue. And we will try at the PRI to keep the conversation open and obviously keep working on this. So thank you so much for joining us today. And I hope you enjoy the rest of the forum.
Thanks to Elena and that wonderful panel for your insights. We're taking another short break now, and when we come back, we'll be moving on to the legal environment of sustainability impact through investment. See you soon.